Check. What's going on? We are back. Checking the audio. Let me know if everything is good on your end, because this is the first time that we're back in a little bit. So I want to make sure that we got our mics rocking and rolling and we're good to go. But it feels good to be back. And it's Fed Day. And hopefully the Fed wakes the slumber up for the dollar. That's what I'm hoping for. But yeah, we're back. What's going on, Mike?
Well, I climbed out of my deathbed to get here. Okay. Totally because it was Fed Day. Took a couple trades from my bedroom. Profitable so far, but I'm just, you know what? I'm tired, Ty. I'm tired of being sick.
Yeah, I mean, I've had a perpetual sickness for the last 4 months. Something different every week. So it's kind of, I'm used to. I wouldn't know what to do if I wasn't sick and if I didn't have to wear masks places. It's like the new norm now. It's like
yeah, Bornholm. Look, I mean, he better let me in, because the bottom line is it's his daughter that sneezed in my mouth.
But
when I was watching her,
you know what?
Last week,
but you know what? The baby's taking it better than he is. The baby's a trooper up there walking around chilling.
Yeah, I am a baby. It's so true. When I get sick, I'm like a big ass baby.
It's great. What's going on, guys? What's going on, Michael, Famila, Mal, Bornalam, Chris? Glad to see you all in the chat. But yeah. Sickness going around. There's definitely a sickness in the fucking markets too, because I mean, gold and the dollar haven't done dog. But hopefully, Big Daddy Powell wakes us up from her slumber this morning, because I didn't trade today. It does the same freaking thing every time the Fed comes out, and it just barcodes. But you know, we did get some numbers out today. Market didn't really seem to care, but
Well, that's because you're trading those wimpy ass, you were born trading gold and oil and, currencies. And I mean, I don't know about you, but the stock market has been anything but wimpy. I mean, stocks have been going just basically apeshit to the chagrin of Mao.
Yeah, right.
So,
right. Well,
I mean, it's there's some frothiness, there's risk on, and I hate to say it, but it's starting to look like a bull tape.
I am so glad you said that, because it's funny, because I look at the markets and I look at the equities, I look at what's going on, and I'm like, why does it look like we're going bullish now? Like we're back in a bullish market. We're about to start breaking structure and heading back to all-time highs. It's like the markets and the structure, I mean, they're just looking just too ripe. But
yeah, the January effect, full one. But, as traders, and that's what we are when it comes down to, guys, and for context, we're traders, right? And so you got to be able, we talk about our 5 power virtues, right? And one of them is adaptability. One of them is patience. And, the other one is mindfulness, right? And you got to be present. And that's ever so more true here, okay? You can have your biases all you want. You could see the world falling apart around you. But if the tape, if the levels, if the internals, if the breadth, if rates, if the VIX, if the dollar, yada, 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 is all pointing to the bull side, then you got it. You can't fight the tape. That was one of the first lessons I learned back in 1997. The very first lesson you learn: don't fight the tape. And the tape right now is bullish, okay? And the longer we go on without completely just falling apart, the more all that kindling that's sitting on the sidelines, and I put it in Discord, I put a chart in earlier in the week or last week, showing there's record numbers of cash sitting in money market funds, okay? Why do we look at money market funds? Because, you can't just take cash and put it in the market. Money market funds is the stomping ground, right? To go into the market. So cash on the sidelines is equated by looking at the money market funds, and those things are at record levels. So the longer we don't fall apart, the more those money managers, by the way, money managers get paid to do what, Ty? Manage money.
Is that what they do?
Yeah, they don't get paid to have just sit in cash, right? The more that we don't fall apart, the more that those money market funds, those managers are going to have to start deploying and getting themselves in. That's why you're seeing the dips getting bought right now. So, it's been a great 2 weeks. I mean, it really has. I mean, if you were able to adjust, it's been a great 2 weeks for stock traders.
Yeah, I mean, absolutely. And you're exactly right, because adjusting it is because, as you start seeing risk on, Bitcoin started ramping up the last couple weeks. You're seeing the safe havens, I guess the dollar notably, which is the safe haven rate, it has been the safe haven drop off. So, it's exactly, I mean, it's you're fighting the wrong thing if you're trying to.
Yeah, and it's this January effect. We quite haven't seen one like this. But with that said, I do want to share. Let's get into the charts. But I do want to share a chart, an older chart with you. And I hate when people do this. Share let's look back at 2001 and all that shit, right? But the last time that we had the Nasdaq, start their January up 10% or more, was 2001. So that was the last time that we saw a January that was where the Nasdaq went up 10% or more, was 2001. And you can see this where we kind of popped from this 45 all the way up to almost 60 here on the Qs. And I use the Qs just as a proxy to kind of look at this. And then guess what, Ty?
Oh, imagine that.
The rest of the year, we went down 50%.
Right.
Okay. So, being a trader is, and we talk about this all the time. Okay. To be a professional trader, which is a trader that trades consistently profitable, makes money by trading the markets. To be a professional trader, you have to learn what kind of market you're in, and you have to really be able to identify that market. And right now, the market, this is a nice little bull run within a bear market. So, you have these. I mean, how many times do we talk about this, right? Every time we get a run up, all the bears in the room are just, ready to, you have to give them counseling.
Yep.
Right? So they're not slitting their wrists. I mean, it is what it is. So, you got to keep it in perspective. So that's the last time we had this nice little pop up.
And I remember, I haven't looked at it in a little bit, but I remember looking back at the SPY chart back in 2008 where it looks very similar, where you have the last run before it just dumps to lows again. So, I mean, it's all these same events, different fundamentals, but same events, same movements have the same trends. So it's definitely looking similar to 2008 as well.
Yeah. So your job as a trader is to quickly be able to identify when those markets change and what's working in those markets. The quickest you could do that, the better off you're going to be as a trader. And if you try to trade the same way through market after market, it doesn't work. That's what it takes being a professional trader, is identifying what market you're in, identifying what's working, identifying what's in play, and then kind of go from there. So, I thought I'd put that up there because I know all the bears are kind of,
beautiful,
kinda sulking. But let's get into where our markets are right now. And let's kind of go through this together, Ty. I mean, if you look at the SPY monthly chart, I mean, just, we're in this consolidative pattern from, the 363 to the 410 level in here. We had this nice, we talked about this. We had this nice bounce off of the 50 when we made the lows back in October. And, we're in, the lows are in stage of the bear market.
Right.
Okay. If you look here on the weekly chart, so, we kind of got this trend line that we did break above. But we're still nestled right in here on this weekly chart. I really like looking at the SPY weekly chart because you can see you had some support here, some support, support, resistance. So we're kind of nestled right in here at this 406 level.
Yep. Right.
So, decision time coming in, and we can remove some of this. Sorry, guys, I didn't put up in my morning analysis. I didn't put charts up because my eyelids were shut this morning. But anyhow, if you look here at the daily chart, I mean, we're in an active sequence.
Yep.
Okay, we have been since the beginning of January. And how we know we're in an active sequence because we got the 9 and the 21. And look how the 9 has been support right in here. And then when we did break value and support, 21 really has become in play. And by the way, let me kind of move this arrow. I don't know if you noticed something in here, but look what we got, Ty. Look at the 50 and look at the 200.
Oh, yeah.
We are, and I haven't heard anybody talking about this, but we are almost kissing, and we're like one good week away from a golden cross, which, by the way, would bring in, some professional money managers in, from, in that sense there. So definitely something to take a look at. And you can see if you look back here, when we had kind of the death cross, as usually what happens, you get the market to go the other way, and then that started our descent to lows. So who knows? I mean, we're just so close to having that golden cross there. So I just thought I'd point that out. Moving on to the 4-hour tie. It was interesting because I kind of noticed this maybe look above and drop. We came into support. I'm going to zoom out here. So maybe... and I also noticed this RSI divergence kind of forming here. And I thought that was something interesting of note. So I'm going to zoom in here and give us your take on the chart here.
Sure. So the main thing I'm looking at is going to be this whole area right here. Back in December 13th, this was the last, this was a Fed meeting where they raised by, I think it was 50 basis points. But if you take a look at like more in depth on technical analysis, we are on this, we were in this very similar active sequence, broke through the high here, look above, and then we dropped and continued lower through this, through support. But now what we're seeing here after we had grabs liquidity is the main thing I'm watching is, okay, typically after we come back up to retest this area where we've grabbed liquidity, it's going to be an area where you're going to see something similar, but not as high, and then it reverses. So if you zoom in, very similar to actually what you had said, when you zoomed in, is it almost looks like this current 4-hour has a look above right in this area here, and then lower high. So now I'm looking at something where if we break above this area, then this whole zone here that I was expecting for a rejection, it's given up, and I don't think it looks back. But given the current technicals and the way we're setting up from this previous Fed meeting and this previous liquidity run here is, okay, we're back now retesting it. And so this is where we should start rolling over. And so that's what I'm looking at here.
Yeah. And, these RSI divergences can really
definitely
work out.
That's something as well to keep an eye on too.
Yeah. So I'm really thinking that, we probably run our course up into here on this run. But, again, I just look at the tape today, man, we just can't fall apart. And, I always talk about, guys, if we go back to the daily chart, when you have this active sequence, you don't really, to have a good active sequence, you don't want it to go just straight up, right? You want it to backfill.
Right.
So, you go up, you backfill, you reject it off this 200, nice backfill into the 50 and the 21, and then you go up and you backfill into the 50 again, into the 200, and then you go up, right? So sideways action, backfilling, not bad action. So that's why this, this has looked a lot, we haven't seen this tape fall apart. I expected us going into the Fed meeting, we below 400, maybe down to this 397, and we just haven't been able to reach that level.
Yeah, exactly. And on this chart, structurally, what I'm looking at from the previous high to the previous swing low, because we broke structure here, is we're now at around a 70% retracement, which really in the eyes of Fibonacci is the deepest retracement you want to see before it starts changing market characteristics here. And so now that we got a double retest here and a double top on a bearish move, kind of it makes me think that we're going to start rolling over and pushing even down to all-time lows here, or not all-time, but previous lows here. And based off of structure and Fibonacci. So if we do start breaking these highs here, then I think that we could see some different characteristics in the marketplace here. But
don't make Mal smile.
I know
your play. Please come on. Good stuff. Anyhow, if you look at the hourly chart, we are 30-minute chart hanging above 200 in here. 15-minute chart. Again, I thought maybe we were getting a little head and shoulders developing in here, not happening. So, we're just kind of hanging at some levels. And you can see, we had a nice 2-day kind of drop. And then, once we got back above this trend line, retested it. And then, we've been in a nice little run. Look at this area. I'd like to see this 403.64 in the intraday levels. Tech, looking even stronger. And one of my main thesis for, that I put into the morning analysis when the Qs were down here is like, look, guys, the only indice that had not broken the 200, was tech. Well, that was a magnet, and that was just an easy trade to really kind of go towards. And these upper, time frames, these moving averages, that's how you kind of play these. You kind of look for value, where value is. And markets have a tendency, they tend to be a magnet. And the fact that we kind of came up here, broke and closed below it, and now we're back above it. Again, this is all bullish to me.
Yeah.
From a tech standpoint.
Yeah, it's going to be interesting because, we had these previous highs that we just wicked and ran here, and now we're below. So we're kind of flirting with this liquidity grab, also with this 200. So it's an area that it's either going to make or break tech.
Yeah, it's kind of like all the charts are kind of looking at. We're kind of in that mode of indecision. Here, look at the active sequence on small caps. I mean, just riding this 9 and 21. Guys, this is when you want to hold stocks, right? When you're riding a lightning, it's how we like to call it. You got the moving averages pointing up. And what's interesting, only the 100, they're all getting stacked, Ty. What's really interesting on this IWM chart is you've had a golden cross, and they're all getting stacked. The only one that's really behind is the 100. And, a lot of people don't look at that. But, it's just interesting upper sequence here.
Yeah, 100%. Yeah, Mal. Charts are looking bullish. Fundamentals getting worse by the day. What does that tell you? I think it's just that the charts got to catch up to. It's just the sentiment out there right now in the charts.
Yeah. Well, look, price action is the only thing that pays.
Right. Oh, 100%.
Just remember that. Now, talking about an active sequence to the downside, Ty. Look at this. This thing has been riding this 9 EMA, the 21, all the way down. Finally bottom around the 102. But the question is it going to be like, when we, bottomed in this 10-year tranche here that we were talking about, and then it finally broke? What's your thoughts on this?
Yeah, dude, I just have a bad taste in my mouth with Dixie right now, because it's kind of been my trade as far as trading against it with gold and my pairs, but it hasn't really had that much of a significance right now because of the price action. But really, in my eyes, is this is the last area that it's got to put up as defense if we're going to continue. Because also, if you take a look at the area we're at, you don't have to hop to it, but it's the 50% retracement on the monthly chart from the entire bullish run we've had on the dollar. We're now at the 50% retracement, which is where we're bottoming now. If we start breaking through this level here, then it's going for a deeper retracement, at least down towards 99, this area here. But I'd like to see it hold. We've had a big enough retracement. We've had that 50% run down. So now, ideally, we see a pop and we start seeing it run again. But obviously, we'll see what happens.
Yeah. And you look at the dollar, then you look at rates.
Yep.
Rates kind of, doing the same thing. They're just not going anywhere.
Right.
Just not going anywhere. So that's two of the, and then you look at the third one of the three horsemen that we follow, the VIX. Look at these bars. You could see where we are. We've had these bear market runs start out of this zone. This lately in 2023 has not really been the case yet. You know, and I really don't like looking at moving averages on a volatility
Mm-hmm.
product because it doesn't mean anything, right? It's not about charts here, but it is of note that, you know, the 50, you know, that we've kind of, it's been a lid and we kind of stayed. I mean, just what I look at, you know, if you look here every few at least once a month, you'll see a nice wide ranging volatility bar, right? And I guess we had one right in here, but I mean, it just seems like it's gotten tight. And, you know, long dated, what I've noticed is long dated vol, it's just disappeared. And, you know, we've got the ramp of the zero dated, you know, the options where everybody's, you know, kind of playing what I've been playing for years when I've traded options. It's just, you know, trading, you know, you know, options that expire that day. And, you know, I think it's having an effect, you know, the playing of those options had an effect on this volatility scheme. Because if you look at long dated volatility, it's really, you know, down, especially heading into, you know, this is the week of all weeks, right? I mean, I can't remember when we've had such, you know, fundamental news events, so many fundamental news events in 1 week. I mean, we got the Fed today, you know, and we're done this. Don't forget Friday, non-farm payrolls, baby.
I've never seen so many news events. Like we have the pound rate hikes, our rate hikes, jolts, NFP, ADP. You know, it's it's just a bombardment. But it's just interesting that the last 2 years of this doom and gloom, we haven't seen any volatility. And if you just look at the VIX, it's just stabilized in this range here. So it's like,
yeah, even the MOVE index, which is the volatility index for bonds, breaking 100 first time in a long time, I can't even remember, which had been elevated throughout. I mean, bonds have just basically calmed down to where they normally are, and that has even dropped off the cliff.
Yeah, the moves on like a spiral down here.
Yeah, Mal, as I get us prepared for the Fed, I'm going to get a little bit into that more. Things not really setting up for the way the Fed wants it to set up.
Not at all.
Yeah, but I mean, you look at this. I mean, it's the three horsemen that have really through all of 2022 basically gave us, you know, at least from the summer of 2022, gave us, you know, credible trades. You know, you can see all of them are looking bullish charts. As far as basically meaning that I'm trading from the bullish side, you know, looking at that.
Right.
So we'll have to see, you know, where that kind of takes us. And if we break down sectors, I mean, you can't ignore this. Look, financials, right? I mean, just look where financials and banks are right now. Now, what's interesting to me of note, if you look under the surface and you look at the regional banks, and I know my charts have been going kind of slow here, so I apologize about that.
Thinkorswim.
Start them. But if you look at the regional banks, Thinkorswim, you know, finally getting a little move here, but they had really been lagging. So maybe a little bit under the surface there. But look at semiconductors.
Wow.
I mean, just
semis are in a breakout.
They blew through this consolidation like it was nothing.
Yeah, dude. Semis look bullish as hell.
Yeah, semiconductors bullish on that bullish ride. And then, you know, you look at, well, let me go back. Hold on 1 second here. For some reason, I effed my charts up. And it's worth waiting for the spin of death time.
Yeah.
I'm just letting you know.
The spin of death.
The spin of death is, you know, thank you, Thinkorswim, but it's definitely worth
It's like the red ring on Xbox, something you don't want to see because you know.
Right. So, biotechs. We called out some great trades in here in Discord in the analysis channel. I mean, we took this breakout here, just really nice. When you get these long consolidations, great breakout. This gave us a nice little trade. And then we called this breakout here for another trade, which gave a nice 25% trade in options. And it's still kind of holding its active sequence here on the 9. You know, hasn't even dipped down to the 21. So again, looking bullish, right?
Yeah, it is. Very much so.
Retail looking bullish too on a nice little run. You know, getting going. If you look at transportations, almost like an inverse head and shoulders pattern to me. You know, you kind of got a shoulder here, you know, the head, another shoulder. You know, so it looks like, and again, I look at transportation, it's old Dow theorist from 2000s. You want to see them strong because it's a sign of the economy is doing well. So transportation's looking good. And hopefully you guys have followed us, but we basically a month ago told you to stay out of healthcare.
Oh.
So healthcare, in an active sequence to the downside. We called it way back here in December, and it's just proven out. So getting a little bounce in here, but still guilty until proven innocent. And I mean, you've seen it. If you look at some of the charts, Pfizer, you look at, some of the other charts, I mean, these things have just fallen off a cliff. So hopefully you have heeded our words on healthcare and kind of stayed out of the laggard. Oil today. Look at oil.
Do I have to? Oh my God, dude.
Nice little fall off, Ty. What's going on?
I was even telling my my buddy this morning that the only thing I'll trade today, if I do, is oil, because oil doesn't move really with the Fed, and so it's going to be probably the cleanest trade. We had oil inventory numbers, OPEC came out, and then there you have it. Amazing oil move.
I'm going to hand this over to you so you can kind of go through your customized charts and levels. But I just, as a non-oil trader, I had to point this out because, this 100 moving average, offered great sells right up into here, this 82 level. It also coincided, obviously, with a nice little level there. And then you had some nice support, which finally broke on the 50. So I just had to show you that because I thought it was interesting. But I don't trade oil, and so I just want to point that out. But go ahead, Ty. Why don't you get into a little bit more detail on some of your levels on your side of things?
Yeah, if you want to see it, you can enable sharing, or else I'll just show the lovely people on YouTube.
I rather hold on one second.
Yeah, you don't.
I hate Zoom. Have I told you that?
Yeah, you got to enable it so it's automatically like you can share.
Exactly. I'm not a good sharer. Everybody knows that.
Oh man! All right, where'd my lovely face go? There it is. All right, cool. So yeah, oil. Today was a pretty clean day. I mean, if you look at the overall move in oil here, we were resisting this, I guess, 82 that Mike pointed out, which very strong resistance here, in an area that it was around the 50% retracement of this previous move down here, triple top. But after you see all of this rejection, you see bearish engulfing, you start seeing price break structure here on like the 4-hour time frame. You can start seeing it breaking these lows, retesting that break, and now dumping. It was pretty predictable, pretty easy trade. I didn't take it because I wasn't trading in front of the Fed. But regardless, looking at the higher time frames on the daily, it's, Borlam's coming close to my buy zone as well. And so it's really been interesting to note because, as Mal was saying about the dollar deteriorating, not looking good for the Fed, typically because, energy would rally off of a weak dollar. Energy really hasn't gone anywhere; it's been stuck, which is in their favor. But it's a matter of time before everything catches up to the charts here. That I think oil starts pumping here, because if you look at the higher time frames on the weekly chart is really basing pretty strong in here, creating these higher lows, and so it's around 75 area is where I'd like to potentially pick up, or I guess look for oil to base and then start rallying out of here, because that was this pretty strong area back in 2018, high there, high again 2018, high here in 2021, and now that was the low around here in 2022 of September, and so it's coming down to an interesting point here on the higher time frames. 4-hour again, creating these higher lows and higher highs here, so. It's coming down to an interesting buy area, but again, charts would have to confirm if we do start breaking down into 74, down into 72, then keep an eye on it, because if you look at the weekly 200 moving average, I got to turn it on. Where did it go? Weekly 200 moving average is sitting right here, down. This is the SMA, right? Yeah, it's sitting right here down at 65. So if we do start breaking through 73, then you're going to start seeing a push down into this zone here, at around 65. But I don't think it's going to happen. I think we could start potentially getting a rip out of here in oil. But again, it's tough.
Yeah, it is tough. It's so many competing forces on oil from a fundamental standpoint. You got China reopening. You got, if we're heading a recession, demand should be coming down.
100%.
Inventories are building.
That's why you're seeing that's why I think you're seeing this consolidation, because China's been reopening, but we're potentially heading into a recession, but the inventories are always mixed bags. So it's kind of just been just a mixed bag in general for fundamentals and oil here. But definitely.
Now, I want you to write this date down, Ty.
Okay.
February 5th. Okay?
Yep.
Everybody write that date down and see what oil does.
February 5th. Okay.
Russia oil embargo starts February 5th.
Oh, that's right. That's right.
So, the spigots have been turned on, spigots be turning off. So, be interesting to see what happens from that fundamental event with the Russian oil embargo.
Forgot about that. That'll be really interesting. Shit, because maybe that'll get oil running out of here, taking some supply off the market.
Yeah, absolutely. That would be nice. I mean, and you had OPEC this week too. We didn't even talk about this, but I guess they said they're not going to change anything. Right?
Yeah, that's right. I forgot to mention that. They're not changing anything. That's why I thought today was going to be a pretty solid day, because you saw Friday after OPEC mentioned that they were potentially going to leave it at nothing. Today they confirmed it, so you saw the very similar move, which you could have predicted off of this retest here. So very easy trade today. But yeah, OPEC didn't change a thing, so they obviously don't see any change in demand or I guess any of that. So yeah, that's that.
Crazy. Well, good stuff, man. Good stuff. I mean, it's now I didn't really go through my ES charts, and I want to kind of do that. And we're coming up on the Fed, so I want to get you guys prepared for the Fed. We've had some good trading through news events. A lot of traders, they stay out of it because they don't have an edge, but we've had some pretty good things. A couple things the other chart I wanted to show you, Ty. You see copper.
Oh yeah.
Right. So the metals have been running. Metals been doing their thing. Which going back to inflation, that's another story, right? Because we've had now like 2 months of metals running here, but copper kind of led the breakout, and they call it Dr. Copper for a reason, right? Because typically a lot of things in the economy are made of copper, and this kind of is the breakout in stocks kind of started with copper, and now we're kind of starting to see it roll over a little bit. So it's going to be interesting.
Pull out 2 more years on that chart.
2 more years?
Yeah, because it's going to be to do 3 years, because it's coming down, like you said, to a really interesting support here over right in here.
Yeah, right in here.
This whole zone here. So it's going to be interesting to see how it reacts here. If it starts giving back through this level, then, well.
Yeah, it's going to be interesting. So copper, maybe a little sign starting to roll over. The other thing is high yield growth, right? So going into the Fed, one thing we've definitely noticed is high yield growth, financial conditions have started to loosen, right? And that's never a good sign for the market, okay? And so as we're going into the Feds, we get a little bit more into it. It's definitely something that I want to kind of look at and kind of think about, because, what's priced in, what's not priced in, it's something that's interesting to look at. But going in here, I wanted to show you this on the ES. So if you look here, ES, we talked about all these charts kind of being the same, all in kind of like that decision mode. But if you look in here, you can see you got this February low that kind of printed down here. And then you kind of got these, on this level. And then you kind of you had this level right here kind of peak up back in December, peered across this trend line. And then on this recent run up, this is that same level, that 4110 level right in here. So definitely an important level. And then you got this level, the 4128 kind of sitting above. So we get above and break all these, then I think you could definitely see a nice little run in this market, and you could see it, maybe we get some momentum going. So it's something to think about on the ES as we kind of look in there. And you can kind of see, from the January, February high, we're still kind of above it. But we'll get into that a little bit more. But I want to get into stocks, Ty. And this stock, I alerted in the chat yesterday at $8.50. Okay. Can you see this, Ty?
Yep.
This MSGM You know, right? I'm sorry. I think it was $10.50 that no, it was $8.50. It was down in here. Okay. So we were looking at it right up in here. On this, it was kind of going sideways, kind of distorted because how far it went. Right here, $8.50. Zoom out, $80 overnight, Ty.
That's just dirty, dude.
Okay. $80 overnight. You know, I want to borrow Mal's quote, you gotta love these effing markets. Right? I mean, just insane. And there's been some good trading, guys. Along with the one stock that I've been kind of recommending everybody, this AI stock. And now I hear everybody talking about it. Look at this trade yesterday.
Yep.
Yeah, I mean, and I'm still holding this one. Okay, we took day trading shares, but look, I mean, this one, we traded it up in here. We recommended it in here with this nice little base. Went up, filled the gap, pulled back to the 50% retracement level, and now we got 2 days of just, really running. And I don't know if any of you guys have tried this Chat GPT, and I know you guys were all talking about it in the Discord room. That thing is insane. And Microsoft is pumping billions into this. Google, Amazon, they're all pumping. So I really believe that AI is going to be the next big thing. So, and there's not a lot of the stocks. Another one AI stock that we were trading yesterday was this BBAI, and it gave us a really good trade as well. We kind of expanded out. But I mean, any of these AI stocks, and here you can see the trade that we had in here yesterday. It was just a nice little run up. I think we got in at 350 and it kind of went up to 450. So just beautiful run up, nice little trade. So all these AI stocks, I think you gotta look for them. You gotta be in them, and you gotta know them. And then you got other stocks. I mean, here's one from your days as a low floater. A lot of people don't realize you were a low float trader.
Yep.
I was looking at his BGXX. It's up almost 200% today. But, I mean, look at these patterns. I mean, look at these charts. I mean, just incredible. My big trader today, and I really wanted to put this, yeah, me too, Borderline. I've been using it too, and we'll talk about that later. We were using it to help us with the website.
Yeah, right.
But AMD, I mean, look at AMD. AMD, first off, is cleaning Intel's clock, okay? This one, I wanted to kind of put, I was sick yesterday, but I was going to recommend a YOLO going into earnings because, Intel shit the bed. AMD owns them. Ask anybody, you know it. This would have been a great options play, even with the implied volatility suck. So, nice trade if you were in AMD. So just nice 2-day trade going from 70 to 80. You look at the daily chart here, and again, it's a semiconductor. And again, what do we have here? What moving average in play? The 200. So nice. So there's some action in these markets. There is some great trades to be had. So don't just just don't sit on your hands and get into the pool. Water's warm, Ty. Water's warm. Anyhow, that's about it. I just want to point some of those stocks out. Let's get ready for Fed because we got about 15 minutes. 15 minutes. Look, this is an easy one. Okay, this is an easy one. 25 basis points. It's going to take the Fed funds rate up to the 4.5 to 4.75. It's not a dot plot. We had that in December. Okay. So what we're looking for is the statement. I mean, if they were to go 50 basis points, you're head down. But I mean, let's face it. Okay. If we look at the economy, look at the numbers, manufacturing activity is dropping, right, Ty?
Yep.
Okay. We got weaker retail sales. Layoffs are spreading like wildfire. Okay. There's one sector of the economy that is killing you. Okay. One sector of the economy that's killing us, and that's the labor market. Okay. The labor market is as tight Well, I can't use that joke on the show.
Yeah.
But let's put it this way. The labor market is as tight as Bornelam's wallet. Okay? He ain't opened up that thing for nothing, right? I don't know. I had to use some kind of joke. But anyhow, it's tight. And you look at Jolts came out. Tyler, Jolts came out today, and there's 11 million job openings.
Yeah. Right.
Up from 10.2 million in November. I mean, if you don't have a job right now, it's because you're not looking.
Yeah, right.
Okay? Because there's more job openings than there are unemployed people. And so that right there is the problem. And we talked about this inflation fight. I love listening to all the FinTwit morons. Okay? Constantly thinking they're inflation experts and market experts. Okay? Inflation is something that doesn't go away. Okay? It's hard to go away. It's kind of like when you get syphilis. I heard. Okay? It's hard to go away. Anyhow,
I've heard.
Anyhow, I mean, look, we got a PCE reading last week. It was 4.4%. Okay? Core. We got core CPI last month, 5.7%. Okay? The narrative of peak inflation has happened. Probably true. Okay? But 5.7% to the target of 2%. And by the way, the Fed's target of 2%, if you look at the last 15 years, last 10 years we've been living with, is still way more than we've been living with typical inflation. So, you know, we've been in basically a zero inflation environment, and here we got inflation stuck. So here's where the stickiness of inflation comes in. Here's, you know, and so getting it from 4.4 or 5.7% down under 2 becomes the issue.
Right. I was going to say, going from 9 to 6, I mean, that's pretty easy.
Yeah.
But going from 6 back to 2, now is the tough part.
I mean, and don't forget, this is on top of a high reading from a year ago.
Right. Yeah.
Okay, on top of a high reading from the year before. So, inflation is an issue, and the problem is with all this loosey-goosey financial conditions, with what the bond market's doing, that is just making the Fed's job harder.
Yep.
Guys, we can't jump out of the gate until she's ready, okay? I'm just telling you, man, because, you know, if you look back in the 70s, the Fed had this, they're not going to let up because they had the same problem. What happened with Volcker, he did let up. And what happened? Inflation went from like 11 down to like 6 or 4 or something like that. Then it went even higher because they let up. Okay. And we're already starting to see it. Goldman's predicting that the CPI print for January is going to be worse than expected. I mean, all you got to do is look what gasoline's done, look what lumber's done, look at metals, look what's happened. You know, we're starting to see this stuff creep up. We even saw oil creep up. Okay, so inflation is still an issue. So, but to me, this is probably one of the most easy Fed days we're going to have.
Yep.
100%. Okay, because all this stuff is priced in. And they got to be pricing in. I'm sorry, we may be trading like they're going to cut rates. But if any of you moron traders out there actually think that the Fed today is going to announce they're going to cut rates anytime this year or even next year, I want to smoke what you're smoking.
Yeah. There's not a chance in hell.
Right? I mean trade like a moron.
That's what I'm saying. The problem is he's got to come out and say there's still more work to fight inflation. Not, hey, we're cutting rates because inflation's good. So, there's not a chance.
Well, December meeting, he warned financial conditions make it harder for us.
Yeah.
Excuse me. Makes us go longer.
Yep.
Okay. I mean, it's not going to happen, man. I mean, and if he was to say anything to the effect of cutting rates in any language that he has, then yeah, you're going to see the market soar.
Yeah, 100%. 100%.
Okay. But what you got to be prepared for in this trade, okay, coming out, because we have two major fundamental events happening. The first one's today, the Fed. The second one's Friday, non-farm payrolls. Okay. So going into next week's trading week, we will have under our belt more fundamental news information to be able to handle. But going into these events, we are on a bullish tilt, a bullish tape. Make sure you understand that and keep your long-term bias out of this.
Yep.
Okay? Keep your long-term bias out of this, and you got to understand where we are, what our basis is. Right now, it's a bullish freaking tape. Okay? So stop trying to butt your head against it, and let's see. You know, it takes typically a fundamental news event to change a trajectory. So let's see if the bulls get some control and they get anything to gravitate to from these. But I find it very difficult for the bear side today. I find it very difficult because everybody and their mother is expecting Powell to come out and talk the markets down.
Yep.
So if we get that, so in context, and the reason I bring this up, because you got to have context. So if we get those dips on the talk down, because you know the algos will step in, you got to look and see what happens to the dips. Do buyers show up?
100%.
Okay. Do you see any type of basing? That's going to be so important. So I think that we are going to get a push down on a very negative Powell negative Powell talk. And then I think, you know, we're going to look to see how the dips are bought. What do you think, Ty?
No, I'm kind of in the same boat as you. Is like, I mean, technically speaking, and what I want speaking, I want to see this thing fucking, fall off. Clearly, obviously, but I mean, like you said, you can't fight what the charts are saying right now. So, and I'm clearly saying bullish. So it's just going to be, it's just clearly what you said, right? Is like, you're going to get some fluctuation, but if you do see the dips get balled up right away, then that's telling you something, and you might get a rally out of here. So,
yeah, I don't know what Powell could do other than maybe put on a clown hat. Maybe he borrowed one from Simon and run around naked on the stage saying, "I'm a bear, I'm a bear." I don't know what he could do. I mean, look, we all know the yield curve is inverted. It's been since the 80s.
Yeah.
Right? We all know that manufacturing activity, people, they're just not manufacturing anymore. You got rising prices, you got slower manufacturing, and you got lower orders, which, by the way, screams stagflation. Mm-hmm. Okay.
My problem is the last few Fed meetings, since they've been hiking 75, hiking 50, the dollar's just been falling off, the rates have been falling off. And typically you see a run, and the markets have been just, they flinch, but they've just been charging on the last few rate hikes. So like you said, I mean, at this point, these are all priced in. So I'm just waiting for the day that we can, everything's just starting to catch up to itself and roll over. Cause I mean, it flinches at these rate hikes, so.
It does. Not happening. I don't know. What do you want me to say?
I don't know what to even. I mean, Powell's going to have to come out and say something absurd for this thing to.
The only hope the Bears have, in my thought process, is if they come out with 50 basis points.
Yeah, absolutely. That's what I was saying this morning. As if there's somehow 50, then this thing. I mean, it's.
Look, I mean, Matt, we know it's offloading on hot air, but again, remember the quote I always bring up. The markets can stay irrational longer than you can remain solvent.
Yeah, right.
Okay. I've learned a long time ago, not trying to make sense of the markets.
Yep.
I can't. I don't make sense of it. People try to tell me, well, it's forward-looking mechanisms, and it's not. I mean, look, the typical, typically, well, we'll get into it. I mean, look, it's just a tough tape, and I don't want to see traders get hurt because I see it with their biases, and they're just constantly, I just don't, don't get caught, don't get sucked in, man. Let's let the market.
It's interesting because if you look at the overall markets, and I'm talking about the Dixie and gold, and we've been seeing that, okay, on high inflation, the Dixie's been going up, and the inflation hedge gold's been going down, and you've been buying it. They bought the Fed's system. But now you're seeing gold soar to where it should be, and the Dixie drop off. So now you're seeing the consumers kind of switch pace here. So, and I've talked about it before, when recession hits, the Dixie drops first and then rallies. So it's going to be interesting to see if we start seeing that reversal in the Dixie, that maybe this was just a pricey in of inflation, or not inflation, recession, and then we start rallying off of what's to come. I don't know, something to think about, because you've been seeing a lot of reversals and a lot of changing of characteristics out there with those safe havens. So
yeah, good point, Ty. Good point. Well, we're about 4 minutes away to the statement. And again, you're looking for changes in the statement. This is how stupid people look at the statement. He made a statement the other it was in the statement. Ongoing increases will be appropriate going forward. So now they're looking to see if they're going to say take will and put likely.
Yep.
God help me if I was a Fed governor, because I can't remember what I said 5 minutes ago.
I know.
So that's how stupid the markets are when they're kind of reacting to this. So let me get the chart set up so we kind of share. Up. And
what's going on, Mo? Welcome back. Welcome back, Mo.
Mo, what's up, buddy?
What's going on, big man? Good to see you guys back.
The big thing, big man. It's nice to see you guys again, man. What's going to be nice to me is going to be it's going to be the conference call. I'm not the conference call, the press conference. That's what it always is. It's always the press conference, always the conference call. So that's what I'm looking for into this.
Oh, 100% the conference call. Mo has some big news in the chat. His daughter just delivered tonight at midnight today. So, wow.
Yes.
Congrats, my dude. I'm so happy for you.
Oh, so I got to ask Mo a question. We got like 2 minutes. Mo, you're a doctor in Chicago, right?
Oh, is he in Chicago?
Are you in Chicago, Mo?
I can't remember. He's somewhere over there.
Or is he Detroit?
Well,
I can't remember.
I don't remember. He's somewhere over. Yeah, Chicago. No.
Okay. Oh, in Chicago. Oh, well, Borderline's in Chicago.
Borderline.
I should have told Borderline. So Tyler's twin sister is, getting ready to graduate from med school. In Chicago, the hospital in Chicago is one of her top choices to do her residency in. So, yeah. Just
I think he's in like Minnesota or something.
I told her though, don't do Chicago, man. You're gonna get killed.
It's dangerous there.
Yeah, danger. But all right, let me share this chart. And see what we're looking at here.
Market's starting to rally here. 1 minute left. Starting to get a little bit of a pop. People are getting antsy.
Can you see my chart, Ty?
Yep.
All right, put you guys up here because I don't need to see you. I need to trade. Get ready for some order fills.
The market's already moving here. Ann Arbor, Michigan. Oh, thanks. Look at that, Mo.
Michigan. I thought it was Michigan. Thought so.
Thanks for the support, my buddy. Chicago.
Yeah, we love you, Mo.
You learn a lot. Yeah.
All right, here we go.
30 seconds, guys.
You can see the charts, right, Ty?
Yes, sir.
I got to take my stop strategy off because I'm not getting like order filled, stop filled.
Yeah. All right, 15 seconds left.
Remember, guys, just let the market do its thing, okay? Just let it do its thing. It's already, algos, are already structured and ready. 2 seconds, here we go. Ding, ding, ding.
All right. See, market's dropping. Trying to see what the news. Oh, market's dropping pretty good here. What'd they do? It's probably just algo driven, obviously.
Yeah, this is all algo driven.
Still waiting to see what the numbers came in as. 25. Yeah. So yeah, as expected, they hiked.
On game will be appropriate. So they did not change that all.
Yeah. So let's look at this statement. Nothing yet. So algo driven because we raised hiked, obviously. Yeah.
All right. So we got exactly what we wanted.
Yep.
And they didn't say likely. They said will. All that bullshit that we talked about.
Right.
Okay.
Fed says inflation has eased somewhat but remains elevated. Ongoing rates appropriate, obviously. Will be appropriate, yeah. So considering extent of future increases in interest rates. So yeah, I mean that's pretty much.
All right, I'm going to start drawing my Fibonacci's just in case the move's done.
Unanimous 0.25%. Yes, that's. I mean, I wouldn't expect. Now, I thought this last time. I wouldn't expect any type of breakout or move from this. It's just going to be a chop algo move. Don't
get chopped up in the algo move.
Yeah, I wouldn't expect this to really go anywhere because really it's going to be everyone's expecting this. It's going to be what's the 230.
So you saw the run up in the Dixie, and now we're kind of pulling back into it.
I pasted the statement in the chat if anybody wants to read it.
Dip buyers are lurking, though.
Yeah. Russia's war against Ukraine is caused tremendous. Committee seeks to achieve max employment. It's the same thing he's been saying.
Let's kind of zoom in here and just not let this. Okay, getting. What do you see in anything, Ty?
No, I was just reading the statement. Nothing really in the statement that just stands out. Pretty much everything that we were talking about. So it's going to be. I wouldn't expect much movements from here.
Right.
Yeah. So.
Let it kind of clear its throat a little bit.
Yep. I mean, yeah.
Rates are rising. Something to take in consideration.
Yeah, the Dixie is starting to rise. Rates are starting to rise. But still 27 minutes left, so we'll see. Yeah, it's a very muted reaction, Mo. I mean, and probably to be expected. It's 25. It came in line, and they didn't say anything crazy, so.
Waiting to see if the dip buyers show up in here.
Yep. Let's see.
So right now, just not again. I mean, rate 10 years not even above 3.5. So
yeah, it's pretty muted out there. Just chop. So everything's going to be.
So right now, 40.52 to kind of this 40.80 level, kind of hanging in here for us, right?
Yeah. I wouldn't be surprised if the next 25 minutes just chop in this range, but we'll see. Dixie's starting to elevate again, continuing back towards this recent high.
Yeah, I think if you get the dollar back above 102, that would be something of note.
Yeah, right.
Don't forget, we got the press conference coming on. We'll have this for you live.
Yep.
That's where you'll get some of these moves. But right now, dip buyers, I guess, showing up. I mean, they're again. Market not falling apart. Let's put it to you that way.
It's not falling apart because I feel like it came in line, right? But it's not breaking out because, like, who wants to get in a buy before the Powell comes out? So I just feel that's why I feel like it's not going. That's why I feel like it's not going to go anywhere. But
nice little push up in here.
Yeah, Borlam, that's how it's been lately. But this is going to be one of the most important meetings for Powell as far as if he wants to.
Well, why I think this is important to watch the action in here is because, can the dip buyers control themselves? We talked about it. I mean, there's a lot of people just, lurking to get in and make this happen. So, this right now so far 40.62 seems to be a point of inflection. It's important for the ES, so I'm kind of watching that level in there.
So I'm trying to play this through my head, right? If this becomes nothing and Powell comes as expected, nothing, do we just continue as is and we're going bullish with the charts? Is that what it's kind of
it's kind of how I'm thinking.
I mean, I don't see anything else otherwise.
If as long as the dollar and the 10-year kind of hang in there. I mean, look at VIX, man. Just VIX is like
VIX isn't moving, is it? Yeah.
Can't get it. You're like the 80-year-old man. You can't get up the stairs.
Need some Viagra or something.
Yeah, and don't forget, that's a good point.
Yeah.
So we have Apple, Google, Amazon earnings tomorrow.
Very good point.
And then we got non-farm payrolls on Friday.
Yeah. There's still plenty ahead, so it's a good point.
Good. So far, the dollar, as expected, the only thing that you're really seeing is as far as being...
Good, because I want to see gold get the F out of this range.
Tesla up at highs, 175 for the day here at 15-minute high.
Yeah, Mo. I mean, if he says, something like that, which he could, then I think you see a sell-off potentially.
Yeah, well, the key is the next...
Exactly. Like, what's the ongoing rate hikes look like? Right. All right, look at that. Your dip buyers are coming in, so it'd
Here
be...
come the dip buyers.
Let's see if they can run it
Charge!
Run it through highs of the day. If they can run it through high... This could be interesting to see, because...
Oh, there we go.
Highs of day sitting at 40.89.75. Or something like that.
Here we go. So let's see. Yeah, it does feel like we're going green. Like,
I don't want it to go green, but it does.
no, I mean, it's too early. Can we at least get through the press conference?
That's what I'm saying. Or the Qs are, yeah, wow, I didn't even look at the Qs. Qs are fucking ripping.
Yeah, they're ripping.
Wow.
Well, I told you Tesla broke 175. Now it's 176.
Wow. So the dollar's falling back off. Yeah, lot of chop. 20 minutes. Let's see if they take it anywhere.
Nice big 5-minute bar on the ES.
Yeah. Right. Yeah, it was unanimous, Borlam. So that is interesting.
Yeah, Fed swaps pricing in 4.9. One more 25 basis point hike, which is pretty much what we started the year at.
Right. Yep. Another. Yeah.
Getting some movement in some stocks, too. Tesla, NVIDIA. So the VIX just
about to say VIX ain't budging.
VIX, the dollar, everything just puking.
Yes, heading towards its daily high. Nice 5-minute close.
Yeah. Everything just puking, which is, pointing to Get her going, run up.
Oil was selling Mo earlier with the oil, the inventory numbers, the surprise build showing lack of demand. So that's why oil was selling off earlier. It's actually popping with the Fed right now, or with the numbers.
Yeah, you had that inventory build too.
Right. That's why it was dropping. The IEA director does not expect any major problems or disruptions from proposed Russian oil products price cap. Huh.
Here we go.
Interesting. Yeah.
So, interesting. Let's see if we get a little pullback here. I mean,
yeah, we reached the upper end of the range for the day, so let's see if we start rolling over from here. 18 minutes left. This is so funny. So, so they said in the or I guess in the statement that what's causing a lot of high uncertainty and inflation is the Ukraine war, and now the Ukraine deputy defense minister's out here talking, saying, "Man, there's fierce fighting that's continuing, and Russians are making powerful attempts to break through defenses." So now the Ukrainian deputy defense minister's out here fueling the fire on inflation at the same exact time. It's so funny.
Of course he is.
As if he's not, as if Powell's not over there giving him a text saying, "Hey, fuel this fire." I just saw a tweet. Nothing was said to derail the AI theme. Yep.
That's great.
AI is.
Yeah, we got a very thin. You know, the levels are very thin. You know, it doesn't take much to move this market.
Yeah.
So that's the other point that you really got to look at too.
Chances of a 0.25% basis hike in March are at now 86% now.
Well, we got nothing but positive ticks. I expect as we go into the press conference, you're going to get some kind of pullback. Just, you know, again, watching the pullbacks. So the very first pullback, I mean, they couldn't even wait 5 minutes before they were buying this thing up. So it's exactly what we were kind of talking about with the tape. So now the question is, can we get a nice little pullback going into the press conference?
Right.
I'd love to see SPY 400.
Yeah, honestly, I mean, I could definitely see that. I could definitely see that. I mean, I could see lower than that if things go in line with that. If it reaches towards 400, I could definitely see even more.
All right, be nice if we get rates to pop up a little bit, wouldn't it?
Yeah, it would be. So 85% chance of a 0.25% in March and a 50-50 for a pause in May. So let's see.
Surprising we haven't seen like a big algo push.
Yeah. You also got to think, what's going on overseas, and the pound and euro are still hiking 50% because they're in a recession and their inflation's still fucking high as shit.
Right.
So
Right.
overseas, you
Exactly.
still got heavy inflation and 50 basis point hikes.
All right. See if we get a little push down here. Ty.
Yeah, looks good for it.
Get the dollar starting to creep its way up. Come on. Come on. All right, I took that little short right there.
Nice. Yeah, pushing right back down to where.
Just a quick scalp.
It's back to the scene of the crime. Is that?
Yeah.
There we are. So we're kind of fluctuating between the highs and lows of this move now. It seems like probably for the next 13 minutes, I'd imagine.
All right, let me see here. I'm going to redraw these Fibonacci's now.
Yeah, now that you have the high and low of the move.
Yeah, now that I think we have the high and low of the move.
Should, but
Yeah, let me see here.
we have 12 minutes left. People are fucking crazy if they push it one way or the other. $40.70, right around.
Yep. You got our Janet Yellen press conference ready, Ty?
Of course.
So I can't believe. So Mo's a grandpa.
Mo's a daddy.
A daddy, I mean, right?
Yeah, Mo's a daddy.
Damn.
He had a daughter that was born
That is
at
awesome.
midnight. Good for you, buddy. I have a daughter being born in March. My second daughter. So
Yeah. You got your second one, and that's just really awesome. Now the fun begins.
yeah, right. Bounce off of 50%.
Yeah. Nice little wick off there. Would have been good for a nice little 6-point trade in ES.
Ten more minutes. We're getting there. We're getting there.
Yeah, we're getting there. So far, very orderly trading, Ty.
Yeah. It has been.
I think we're going to have some good trading opportunities come up here. So let's see what we got. I know Bornlom's looking for 400 on the SPY. I would love to see that.
That'd be fantastic. I hope we get it.
Oh, man.
I am 100% with you on that, Bordelon. I think if we close around 400, we're seeing that sell off. And that should give us a nice push in the Dixie. Gold should be dropping. Oh, in the best ideal world where I'll make a bunch of money is we see the Dixie to break out, markets to fall, gold to fall. Oh, I can feel it.
Me too. I'm with you guys.
Oh.
All right, come on. All right, so that bounce off of the 50% retracement right now, good
10
for
points.
about 8%. 8 or 9 point rally in the ES. That's not a bad trade.
Nope.
Fucking.
Yeah, 8 minutes. Likely just chop in their range until the meeting.
Let's go, baby. Let's get this press conference underway. I love the press conferences.
They're my yeah. I like them and I hate them. I hate how long they are. Just like sometimes you
know.
get just sitting
They
here.
ask the stupidest
And I know, but it just
Let us know, guys, if you're making any trades. Like to see how you guys are doing.
All right, let's see if they got Big Daddy up there. Yes, they do. Let's open that up.
All right,
Get
I'm
it
gonna
ready.
stop sharing, Ty, so you can
Awesome. All right, I'm gonna
share your.
All right. Where we at here? Un momento. Yes. All right. I feel good. Dan it. All right. Transition. Share.
I don't know anybody that was expecting a friendly Fed today. I mean, if they
Yeah.
were, just not very bright.
Right. Yeah, baby. FOMC viewing party.
It's a party.
Now it's a party.
We don't want to miss him walking up to the stage, Ty.
Oh no, I got it up. It's up there.
Excuse my cough. Why does it look disjointed to me?
What do you mean?
I guess that's just on my.
It's just on your. It's on your view.
Remember dual mandate. You know, Pocahontas is poking her head out, Tyler.
Pocahontas, of course she is.
Elizabeth Warren. Come
Yep.
on. All right, let's get her trade on.
All right.
Why isn't that?
I fixed it for you.
What's that?
Do you want me to? So I shared just the stream for you. Do you want to see the charts? Because you got your own charts up, right?
Yeah, I got my own charts.
All right.
I thought we had a little banner, Ty.
We do. Look at the YouTube.
I am. Okay.
It's up for me.
I thought it looked different before. There it is.
This is what we've always had.
Gotcha. As long as Janet Yellen's there with us, we can.
Janet is there.
Switch the chart to the ES for me.
Yerp. Oh wait, you're not even seeing the ES. Oh, you just for them?
Yeah.
Gotcha.
Jackson Hole Powell. I don't even know if Jackson Hole Powell will deter these degenerate.
Yeah,
fools.
exactly.
All right, I can finally turn that.
Pocahontas, get out of town.
All right, come on. I'm looking for a nice trade somewhere in here.
Let's see here. Where were you at? Yes. 5 minutes. All right, baby. 2.5 minutes about.
Why can't... Oh, there we go. Okay. Put this up.
I agree, Borlam. They should have done 50.
50 would have been the way to put the tamp. It would have damped down.
Exactly.
Some of the stuff. They're not committed.
Make sure you go like the stream, or Janet Yellen's going to come and get you.
Man, look at this. We are getting tight in here, right? Actually, it's just dying down to a trickle.
Yeah, it is getting just really tight in here.
I tell you, you know why I hate FOMC days?
Why?
Because I have to journal all these trades.
Oh God, yeah. Good luck. Oh God, that's brutal.
Tyler, I'm only at 42 trades. Stop.
You'll be up all night.
I already took 2 trades yesterday.
2? Who are you?
I know. I was sick. Okay, cut me some slack.
Hey.
Really just getting tight action in here. Getting a nice little, on the 2 minute, nice little down trend line here that I can maybe, if it breaks the upside.
Yerp. 1 minute left. Seconds. Come on, Big Daddy. Ready for you. Oh, 30 seconds. Do. Let's make sure this audio is working.
They should have like an announcer. And now, Jerome Powell with the killer of your financial dreams.
Yep. Markets. Oh, baby. Is it going to break down? Oh, he's up. Well, not yet, but. All right, guys, I have the volume on, so make sure that, it's good. Give me a thumbs up if it sounds good when he comes out.
I don't like what he's saying, Ty.
Yeah, he's speechless.
I'll take that.
He's speechless.
It's like a cattle call.
Oh, man. Oh, man. Market. Uh-oh.
Here we go.
People are getting antsy.
Right.
They're like, where is he? Oh, here he is. Yeah, he's watching the charts in the back room. You're right.
Right. Well, yeah, let me see what's going on.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Give me a thumbs up if this sounds okay, guys.
In addition, we are continuing the process of significantly reducing the size of our balance sheet.
Red candles.
Yep.
Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments.
Nice wick test there. And
The U.S. economy
the
slowed
ES.
significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates.
Seen some nice
Higher
sellers
interest
come
rates
through.
and slower
Yep.
output growth also
Nice
appear to be
seller.
weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated.
Yeah.
Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago.
Well, there's the test of the load.
Inflation
time.
remains well above our
Yes.
longer-run goal of 2%.
Interesting. SPY didn't
Over
get
the
down
12
there.
months ending in December, total PCE prices rose 5.0%.
I'd imagine this to start selling off from what he's
Excluding
saying.
the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident
Yeah,
that
there you go.
inflation is on a sustained downward path.
Between labor and housing, it sounds weak.
Despite elevated inflation,
Qs are down by their
longer-term
200.
inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Dollars breaking out here.
But that's not grounds
Yes,
for
over the
complacency.
102.
Yep.
Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Market's shrugging this off.
We are seeing the effects
Yeah.
of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing.
Well, they went down and tested the lows.
It will take time, however, for the
So,
full
found
effects
some
of
buyers.
monetary restraint to be
Yeah.
realized,
And plus, it was also the
especially on
40-50 level,
inflation.
which is been a pretty
In light of
important
the
level.
cumulative tightening of monetary policy and
Well,
the
I think
lags
it's
with
right
which
now just
monetary policy
technical.
affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the
Nice
country.
pop-up on the market.
Yeah.
Everything we do is in service to our public mission. We at the Fed will do everything we can
Look at the
to
dollar
achieve
drop.
our
I mean,
maximum
Everything you
employment
said
and
is
price stability
exactly what
goals.
he said last time that
Thank
we
you,
see.
and I look
So,
forward
I
to your
mean,
questions.
Right.
Chris,
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
Look at the market below.
So
Right.
it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see
Wow, the
underway is
Yeah.
really at an early stage. What you see is really in the goods sector, you see
Look at that
inflation
5-minute bar.
now coming
A
down
wreck, dude.
because supply chains have been fixed, demand
Holy
is shifting back
4,100.
to services, and shortages have been abated. So you see that in the housing services sector.
He's stumbling because
we
he just
expect
saw the
inflation to
markets.
continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
I'm sorry.
Go ahead.
Has your expectation for where the unemployment rate might go changed?
Look at the
since December?
VIX drop.
You know, we're going to write down new forecasts at the March meeting,
Wow.
and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. We did see,
Dollar.
we've seen average hourly earnings, and
Jesus.
now the
It's breaking
employment
through
cost
lows
index
here.
abating a little bit, still
Fuck.
off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down.
Oh.
If you look across the rest of the labor market, you still see very high payroll job creation, and you know, quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think, you know, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would
Stocks are
certainly
ripping.
do that.
Yeah,
At
dude.
the same time,
If this
the
Dixie
data
gives up
come in
101.3,
in the other direction, then we'll
it's
make
done.
data-dependent decisions
Done.
at coming
Fucking
meetings, of
ripping.
course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, you know, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage, whereas of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have
Goes the
a
Dixie.
sector that represents 56% of the core inflation index where we don't see disinflation yet.
Ed, wow.
So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible. that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft.
Dow's now green.
And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do
It's a
what
dumb
Treasury directs
question.
as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech. And I wonder if that view is broadly shared on the committee.
The meeting minutes.
She's a blonde.
The committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, And you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon, back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say It's not the most likely outcome, but I would say there's a chance of it.
Michael?
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us, potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence
So
metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports,
really
2 more CPI reports,
There's going to be
and we'll be looking at those
huge
carefully,
opportunity
as all of us will. And we'll be asking ourselves, what are they telling us?
He's pumping this stuff.
Soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job. And it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Beast mode.
Edwin?
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. You know, so we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, you know, our job is to deliver inflation back to target, and we will do that. But I think
lower my charts.
We're going to be cautious about declaring victory and, you know, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great. But we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
You know, so my forecast and that of my colleagues, as you will see from the SEP, and I mean, there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. You know, if that happens, if inflation comes down much faster, you know, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
A question.
That's the general sense of it. Look, we understand, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that, people are handling it better in the economy.
This flu I
and
got
the
is worse
society
than
are handling
COVID,
it better
you
now.
dumbass.
It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Dude, we're going to all-time highs
Marshall
before the
Genzer,
conference is over.
with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainard said recently. She said she doesn't see signs of a wage price.
If you see it, you have a serious problem. That means that effectively in people's decision-making, inflation has become a really salient issue. And once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient. And people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation. And as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and, high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses that essentially we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline?
That's a dumb last question.
Yeah. I would expect a dumb question from you.
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Oh.
Thanks, pal. Buy the dip. Buy the dip. Buy the dip.
Oh,
Jesus,
man.
what a
All
rally
right,
off the
fuck.
40, 50 level. We basically almost went 90 points, Ty. Just straight up vertical.
Yeah. I mean, I don't know what to say. I don't even know what to say. Really, all I have to say is, I mean, the market, you're seeing some extreme moves here, so just keep an eye on how it closes, because, I mean, if it closes a breakout mode the way it is, then, we're in for some more movement, but I'll just have to see how it closes here, because that's a fucking massive move.
Well, it's a massive move, and the problem is it creates a lot of open air below if we don't hold some of these levels. So
Exactly,
just,
right.
It's well, I mean, look, what did we tell you guys prior to? Okay, the tape was bullish going into this. We got exactly what we expected. The Bulls actually got more than I expected they were going to get. He was as dovish as could be.
Right.
Now the dollar did get back above that 101.30 level.
Yep.
So I'd be watching to see if that's going to continue. But don't get caught up fighting this tape. I mean, their dips are getting bought.
Yep. Yeah, definitely don't fight it, but keep an eye on how we close and react to this move here, because could tell you, could give you something. But we do have non-farm again this week and stuff, so a lot left to come.
Yeah. Oh yeah. There's a lot more to come. But I mean, this was an impressive fucking rally.
Yeah, it was.
All right, guys.
Yeah. All right. Well, thanks for tuning in, guys. It's been a pleasure. It was good to be back. Good to see you all again. And good luck trading the rest of the day. And yeah, well, we'll see you later.